South Korea is likely to delay imposing a new capital gains tax scheduled to take effect next year. The ruling bloc is backing the government's plan. The main opposition, while claiming to be largely supportive of the idea, is attaching strings to it. Kyung-eun has the latest.
Lawmakers got started reviewing the government's tax revisions on Monday. Under scrutiny is the government's push to delay imposing a new capital gains tax slated for next year for 2 years. Originally, all investors were to pay a 20% tax on annual capital gains exceeding 50 million won, or roughly $37,000. Those with 30 million won in gains, a rate of 25%. Currently, capital gains are levied only on investors who either own a stake of more than 1% in a single company or have total investments in securities worth more than 1 billion won, around $750,000. The ruling People Power Party is backing the government's proposed delay, while the main opposition Democratic Party has been opposing it because it will lead to lower tax revenues. But reversing its stance, it said it will support the delay in exchange for lowering the tax on securities transactions to 0.15% instead of the government's proposed 0.2%. Both the PPP and the government are against this idea. Finance Minister Kyung-eun on Monday reaffirmed the government's opposition to it, saying that cutting the transaction tax will result in less tax revenue, the very concern the DP has been raising. The two parties will need to strike a compromise by the end of this month, along with other contentious tax-related bills, like cutting corporate taxes from the current 25% to 22% and easing excessive property holding taxes. Then, the bills will put up for a vote on December 2nd, along with next year's budget. Kyung-eun, Arirang News.